GameStop, known for being the meme darling of Reddit users, announced late Thursday in a Securities and Exchange Commission filing that they will initiate a stock split, a move that will drastically reduce the cost of one share. Now, if you're someone who's contemplating investing in GameStop for quite some time, then maybe you'll find your answer right now. For today's video exclusive for our Fortune Fastlane members, we'll be talking about the talk of the town in both the stock market and Reddit community. But before we get into that, let us know what the stock split means. A stock split is simply a division of the stocks owned by a company. This has the effect of increasing the number of shares out there, which lowers their worth. A low share price can make potential investors more comfortable when buying a company's stock. The simple reason is that it isn't worth $2,000 to buy 100 shares, but it might be worth $200 to buy 100 shares. Therefore, companies expect investors to be more interested in their stocks when the share price is higher, because it seems less daunting to purchase 100 shares for $2,000 than for 20. Now, a stock split does not directly change a company's market capitalization, but usually the company's valuation will trend as new investors buy into it. A stock split does not affect the market capitalization of the company, but it generally creates more shareholders who might buy more shares as well. Aside from this, a stock split can help boost liquidity because buyers and sellers will offer higher ask prices on lower priced stocks. For example, if the stock trades for $1,000 per share, with a split, it would still trade for $1,000, but there will be more potential bidders at that price point. Now, going back to our main topic for today, GameStop shares surged after the company announced that it planned to split its stock for the first time in 15 years. They want to increase its share count from 300 million to 1 billion so that it can implement a stock split in the form of a dividend. The Grapevine, Texas company plans to seek shareholders' approval at its upcoming annual meeting. As mentioned, stock splits change the price of the stock per stock only, not the overall value. By splitting the value into smaller amounts, prices can be pushed up, which did so for GameStop on Friday. They increased 8% at the opening bell. JP Morgan says that while stock splits may not be sustainable buyback, they are an additional tool to push stock prices higher. This has been the case despite financial theories saying otherwise. GameStop's announcement comes just days after Tesla announced its second stock split in less than 2 years. Alphabet, Google's parent company, also did a 24-1 split in February. Amazon said this month that it would do a split of the same ratio. These big tech companies pursue stock splits when their stocks head into quadruple digits. This allows small investors that have a more limited financial heft to buy shares, which were previously inaccessible for most as the share price rose. The share of one company such as Google, Tesla, or Alphabet costs anywhere between $1,000 and $3,300. Shares in companies like Tesla, Alphabet, and Apple have been rising from 30% to 60% over the past 12 months. Shares of GameStop have been outperforming the S&P 500 for 3 months. Shares of GameStop surged in after-hours trading on Thursday, following a 0.2% decline at the stock's closing price, 16.9%. The increase comes after a 10-session winning streak that was its longest in 12 years. However, did you know that GameStop also did a sudden surge in its stock price last year? GameStop is expected to lose money last year. Sales are down because fewer gamers need stores to buy video games when they can download them directly from their consoles, PCs, phones, or tablets. However, the share prices of GameStop have been going up despite the losses because they're looking at other sources of revenue. Well, they can thank a loyal group of investors on Reddit who continue to back the stock even when other people on Wall Street have argued that the shares are overvalued and due for a sharp decline. The stock was extremely volatile, so it was halted several times. Shares more than doubled and finished the day 18% higher. Short sellers have been saying that GameStop is about to collapse for a while. Investors on the Wall Street bets sure Reddit must have felt this and started buying more shares, which led to the price jumping up by more than 6%. A number of investors have bet against GameStop by borrowing shares and selling them, anticipating a price drop. They hope to be able to buy the shares at a lower price than what they sold them for and make money that way. But we know that that's a risky strategy. If a stock suddenly spikes higher, short sellers may have to rush altogether to buy back shares or risk losing everything. The more that a shortened stock goes up, the bigger the losses become if a short seller doesn't buy back their position. That creates the squeeze. With the victory of GameStop's vocal bulls on Reddit, it's dangerous to bet against stocks that have a significant cult following. With the recent surge in shares of BlackBerry, another favorite from Reddit's WSB followers, this point is clear. Surely GameStop doesn't have some upside beyond Reddit love. Despite being named GameStop, they don't just sell games. The company is also popular with fans of pop culture collectibles, such as Star Wars toys, Funko figurines, which help attract people who aren't hardcore gamers so they can check out the store. GameStop shared that sales increased by 5% during the 2020 holiday season, and digital sales made it an incredible leap with a 300% growth. However, overall sales were still down because of the temporary store closures and supply disruptions. Retailers probably suffered from a spike in COVID-19 cases in December, and demand for the new PS5 and Xbox Series X consoles from Sony and Microsoft. GameStop declined to comment on this story. Nonetheless, the company is making some changes as it's attempting to become a more digitally focused retailer. And since we're talking about past events, let's talk about what GameStop is. GameStop is a retailer that sells video games and hardware. With 6,000 stores, GameStop needs to sell other items to remain profitable. ThinkGeek, EB Games, and Micromania Zing are alternative names for GameStop products, which include the like of merchandise, gaming systems, and clothing. GameStop sells a variety of toys, collectibles, apparel, and accessories. Alongside their main offerings of gaming consoles and games, customers can trade in old consoles or games or buy pre-owned goods at GameStop. It has faced competition from digital distribution services, and in early 2021, it landed at the epicenter of a short squeeze. GameStop went public in 2002 on the New York Stock Exchange and became fully independent in October of 2004. The next 12 years proved to be a period of great success for the company, and numerous securities were traded on both New York Stock Exchange and NASDAQ because their stock price plummeted. How do you think GameStop is doing right now? GameStop is asking shareholders to increase the number of authorized shares from 300 million to 1 billion. The company was already able to execute a 3-for-1 stock split with just 76 million authorized shares, and the after count was in late January. Assuming that proposal passes, GameStop will be able to split each share 12-fold. After lifting the share ceiling, GameStop plans on using the extra market shares to create incentive programs and as a way to raise capital. Furthermore, they plan on selling these shares to help generate revenue. These shares could become important in the future, particularly if GameStop wants to purchase other companies. Now, what's going on after the announcement? The share price spike has been attributed to Ryan Cohen, the chairman of GameStop, who bought shares in the company. The founder of Quiver Quantitative Incorporated said this increase is likely due to alternative data. Cohen recently bought 100,000 shares of the video game retailer, which puts him at 11.9% ownership. This sentiment is seen as an indicator of how confident GameStop's employees are about their company. It has also caused others to invest in the company. He said that traders who are monitoring GameStop have probably observed the volatility of the stock. The chief operating officer of GameStop commented on how the community's discussion is created when chunks of a company's business are up for bidding. Though some traders seem more interested in buying more shares of GameStop stock and are doing so to keep the price higher. GameStop isn't doing anything productive at this point, but people still buy products from them. People are still buying things that they find frivolous and don't care about the quality. Does this mean the stock split is a bad idea? Although there are some benefits to this plan, there are also some investors who were reminded of some mistakes from years long past. Remember Nokia and Ericsson? These two Scandinavian corporations were two entrepreneurial giants in the telecommunication industry that controlled most of the mobile phone market before smartphones came on the scene. Nokia was responsible for being one of the leaders in developing cell phones, and Ericsson also was a formidable contender. The market was really thriving during the late 1990s, and both of these giants doubled in value over that period. The same calculation reveals that Ericsson fared far better. Though their share price was up by 511%, Nokia ended up earning a return of 1,970% at the end of 1999. Nokia and Ericsson both split their shares several times because they didn't want them to get out of reach for ordinary people. Nokia doubled its share count in 1995 and again in 1998. Ultimately splitting them 4-1 in 2000. Ericsson went through a 2-4-1, 4-1, and 4-1 split as well, always dividing their shares by 4 after each event. With its splits, Nokia was around $50 per share and Ericsson was at about $100. Without the splits, Nokia would have been at $1,600 and Ericsson would have been at $3,200 per share. So it all made sense that the telecom experts were managing their share bases with reasonable stock prices in mind. All in all, the year 2000 was a great year. Right off the bat, the stock market crashed and was followed by 9/11 and then the current economic meltdown. The year ended with the market recovering, and with modern smartphones on deck, Ericsson did some actions to maintain the minimum stock price of their company. First, in 2002, they performed a reverse stock split at a ratio of 1-for-10. Afterward, in 2008, they performed another split on the Stockholm market while doing a reverse split on the American Depository shares. These moves were required to avoid being delisted by the NYSC. These stocks have been near the penny stock market for 2 decades now. However, these are experienced leaders in the telecom sector with multi-billion-dollar market caps and massive revenue. But the stock splits of the golden age dropped their share prices into the low single digits. Even now, the company is worth more than $30 billion each, but its stocks remain in the range of $5 to $10 per share. GameStop is working on a new strategy to compete with big box marketplaces. It's been doing well recently thanks to the meme stock phenomenon, where memes become incredibly popular and small investors pump up the stock prices. Meme stocks have been rising as traders are piling into riskier stock markets. Shares of these stocks have risen after varying news from their favorite meme generators like Reddit. However, it doesn't say much about what this new strategy might be, and GameStop needs to overcome their capital costs with the hope of increasing investor and employee patience. The company's extreme consumption of cash may lead to gradually declining profits and customer satisfaction. In order to stay afloat, GameStop is running out of money by constantly trying to raise debt and sell more shares. That is GameStop's version of the dot-com crash. The company's stock traded for less than $5 in 2000, a time when the market cap was under $300 million. However, financial results have not improved any significant margin. Let's say that GameStop splits its stock by a ratio of 5-for-1. If the market cap drops back from $12.7 billion to $300 million, the split adjusted share price will plunge below $1. And will be taking about a reverse stock splits instead of this current split. though we're not expecting a major disaster here. The thing is, GameStop has not earned its sky-high market price, and it could pop anytime soon. And the upcoming split just started to look like a big mistake. You might not notice, but this isn't the first time GameStop did a stock split. It also happened once before in March 2007 when they doubled every single share of investors that held their stocks. It didn't specify the rate by which it will divide its stock now. It didn't explain how much of the dividend is for stock holdings and how much for other uses. Additionally, GameStop said it seeks shareholder approval for a new incentive plan to support future compensatory equity issuances. This possibly suggests selling more stock to investors. The SEC filing talks about how the stock split is for the purpose of future corporate needs. The annual shareholder meeting will also vote on an updated compensation plan dubbed the 2022 Equity Plan. The proxy statement contains more details about what's being voted on and when the shareholder meeting will take place. GameStop has not yet announced a date or location of its annual meeting, but it did say that it would be in its future proxy statement. GameStop stock surged to historic heights thanks to the meme stock phenomenon. GameStop has yet to announce its future strategy, but one thing is clear, it's going to need a change soon. There you have our Fortune Fastlane video for today. Don't forget to subscribe to our channel, click the notification bell, and like this video. If you think that we have delivered value, please share this video with one person. Just one share is enough for you to show your appreciation for the commitment and hard work we all put together in creating this video that teaches and helps you on your mission of building your own fortune. And you don't know that one share could go a long way. And keep in mind that no matter how many times you're going to watch this video, you won't see any results unless you take action. Goodbye and see you at the next one.